Well, I see that Robert Barbera is here, so we could begin. Robert Barbera is a supporter of these Minsky conferences because he is a known Minskyan. He presently is an academic at Johns Hopkins University, directing the Center for Financial Economics there, and also teaching in the economics department. He has spent more than 30 years in Wall Street, in hedge funds. I'm sure he has a number of things that he knew what he was doing. He worked for Lehman Brothers, he worked for Mount Lucas, he worked for other institutions.
Dimitri?
Yes.
Okay. Your host has blocked me from appearing. I have no problem just speaking to you all, but right now, when I start video on, the host says that you won't see my spectacularly young face.
Okay.
There we go. Thank you very much.
There you are. She heard you actually.
Yes.
So she
heard me at hello.
And he started actually at E.F. Hutton, which was a very interesting house on Wall Street. Bob has written a very well-read book and well-received book, The Cost of Capitalism, which talks about interesting things in terms of what can happen in a system of capitalism. So I don't want to take too much time because I think you're in for a real treat in terms of his oratorical excellence. So with this, Bob, the floor is yours.
Super. Thank you very much. Now, first, always a pleasure to speak at the Minsky conference. Thank you for inviting me, Dimitri. And a pleasure in no small part because I did mid-career get to know Minsky. First, through his work. I joined Wall Street in the early 80s, as Dimitri said. And I discovered my conventional economic training didn't help much in trying to sort out what was going on for the US economy and financial markets. And a friend said, read Hyman Minsky, and I did. Later on, I got to know and of course, the framework in simplest terms is about recognizing that we have to give finance a much larger stage, much larger role, center stage, when we think about a capitalist economy, certainly the US economy. I think right now, if you have that expanded view, if you remind yourself that you have to think about Main Street and Wall Street, fiscal and monetary, then very quickly you begin to see that the debate about the size of the stimulus as provided, for instance, by Larry Summers and Paul Krugman, to be remarkably small, sort of a cartoon version, but it's a more generalized problem associated with relegating finance to side stage. And I want to talk about how with that expanded view, we get a pretty aggressive view on why the size of the stimulus should be quite large. The challenge for the Biden administration with that expanded view is not just to get us back to 2019 unemployment rates, but perhaps to elevate growth rates more generally, and also to simultaneously have to deal with what is an extraordinary amount of excess in the world's financial markets. And finally, if we want to get out of the cartoon version that we confront in the standard debate about the size of stimulus, we have to recognize that you are in a political game a political game that suggests you have probably less than 2 years before you could lose any authority to continue to govern in an effective fashion. So take a look at the political economic backdrop. Acknowledge the central role that finance plays, and then big on fiscal stimulus seems to me still a risk. All policies are risky, but seems to me categorically the appropriate thing to talk about. Now, what I'm going to talk about is 3 frames. I'll start with the cartoon CBO frame as articulated by Professor Summers. And then I'll move on to expand and get Wall Street in there and have fiscal, financial market, and monetary policy considerations. And then finally, I'll get into some political economic theorizing. But first, a caveat, an anxiety-ridden caveat. What I'm going to suggest is endogenous end to social distancing as we get close to herd immunity, plus a big stimulus package is going to give us something approximating a serious boom for 2 years. You know, call it 2 years of 9 and 5.5, something that averages about 7% for real GDP growth. So really impressive growth. That presupposes the COVID dynamic is increasingly a thing of the past. We are confronted, however, with extraordinary and really depressing news coming out of India. Less covered, but just as depressing is what's going on in most of Africa. And if the issue of producing strains, variants, is a function of people who in fact contract the disease, then we really don't need to be focused on 25 million Americans who refuse to get vaccinated. We have billions who are as yet unvaccinated. So my remarks assume that we don't get a strain that can fly right through current vaccines. In that environment, I do think we're set up here, in fact, in the midst of early stages of a boom. And I want to talk about how I think that plays out for unemployment, for inflation, for earnings, for interest rates, and for financial markets. Okay, so let's start, if we could, with the CBO frame. From CBO's perspective, we were at full employment in the first quarter of 2018. So we had about 2 years of growth that got us somewhat above potential. They had a forecast in January before the enactment of the Biden stimulus that suggested the output gap would close over 4 years with growth averaging a little bit over 3%. Now, if we said, well, we'd like to have that output gap closed in 2 years, not 4, you could then do some quick calculations on multipliers and fiscal stimulus and something on the order of 350, 400 billion in fiscal stimulus, and you close the output gap in 2 years. Okay. Now, if we accept that frame, so CBO's notion of the output gap, which Professor Summers invoked, and then say, you know, it should have been 400 and it was 2 trillion. Where does one end up? Well, if you want logic ad absurdum, you could simply argue what would happen if there's no reaction from the central bank, no reaction from the bond market, no response, just continued growth along those lines. You get the impossibility of an unemployment rate at -2.5%. Well, you know, obviously we know that's not going to happen. The concerns from Summers, from Blanchard, from many others, are that in order to prevent that from happening, or as the dynamic of that strong growth bangs up against those output restrictions, we begin to see a serious rise for inflation, a serious rise for interest rates, and a short-lived boom and then recession. Okay. Now, that presumes, of course, that the initial assessments that CBO provided for a moribund recovery are reasonable as assessments for a recovery that's of boom proportions. And I would submit that I cannot say that's going to turn out to be wrong, but we certainly have data that suggests that's not usually the way it plays out. Now, what I'm speaking about is what typically happens to productivity, to participation rates, and to population growth when you're in the midst of a boom. Okay? Think back to Art Oken. I'm old enough to remember Art Oken and Oken's Law. And Oken's Law said that roughly for a 1 percentage point change in the unemployment rate, you'd get a 2 percentage point change in the growth rate for real GDP. The Oken coefficient, as he estimated it in the 70s, was 2. Now, how could that be? Well, what that reflected was the fact that participation and productivity were highly pro-cyclical. So in an environment where the unemployment rate was going down, it was going down, and productivity and participation were going up. And as a consequence, growth was stronger than the implied level of a change in unemployment, and the reverse was true. The Oken coefficient didn't work anything like that in the Great Moderation because it was a moderation, because the big cyclical dynamic that drove those numbers, in fact, wasn't in place. But what we're talking about now, endogenous social distancing ending, restaurants opening, superimposed on that, 2 trillion of surplus, very likely a boom. In that kind of environment, isn't it likely to see some sort of, or isn't it reasonable to say there's some chance we'll get the traditional boom pop for productivity, participation, and population? On the productivity front, can we think back to a period? When was the last time, in fact, that we had a very strong economy associated with big fiscal stimulus soon after a big economic decline? Well, that would be 83, 84. Okay, in 1983, 84, the economy boomed. For 2 years, real GDP growth at an annualized rate of 6.7%. Productivity actually accounted for 40% of that growth, okay, rising at a 2.7% annualized rate. The CBO calculation on where the output gap is looked at 2020 productivity, which was strong, okay, as people were fired pell-mell, decided that we needed to have some give back. And so over their first 2 years of growth for employment, they anticipate very little gains in productivity, something on the order of 0.5%, in fact, a bit less. Okay, well, if we're saying that we're in a boom and we feel comfortable laying at the doorstep of that boom, maybe 1/3 to 40% of the growth via labor productivity, then suddenly that output gap measurement is substantially smaller than it should be when we think about boom levels for productivity. So allow me just that move. Over the next 2 years, productivity is 2.7, not 0.5. And we accept all the other strictures embedded in the CBO output gap. And suddenly the unemployment rate 2 years out isn't -2.6, it's +2.4. Now, +2.4 is still very, very low. Still, for the likes of most economists, would say that the angst that Larry Summers is speaking of makes some sense. Okay. That said, we then have to think about the issue of participation rates. Now, as you can probably tell, if you look at most of the speakers, as I know most of them, most of the speakers give significant anecdotal evidence that the US population is aging. All right. And as a consequence, when you say that the average age is going up, and as you get into the 60s and 70s, the number of people who are working is going down dramatically. You're in a position where, ceteris paribus, other things equal, we need to be forecasting declining participation rates. That said, we had, after the expansion that we came through, and it ended abruptly with COVID, we had seen some rebound for participation rates of some significance by age cohort. And if you're in a 2-year boom, it strikes me that we ought to, at least on an age by age basis, all right, get back to those peak cohort participation rates. And then let me throw one wild card in. Okay, what we've got, as I see it, when I look at labor force participation rates for prime age males, is an extraordinary decline. Okay, we were talking about 92% in 1998 and 91% in 2005, and currently something on the order of 87%. The explanation for that that many offer has to do with the fact that construction and manufacturing employment have done so poorly, and those are the high-paying jobs for those without college. As a consequence, there was a lot of give up because you really couldn't get paid anything like what you used to get paid. We're now talking about a 2-year boom. Can't get into it here with the amount of time allotted, but it looks like a part of that boom is going to be after a cycle that skipped it, a real housing boom. So allow me some better than 2018 rebound for participation rate for that group, hit the other peaks, and suddenly, instead of labor force participation growing 0.5% a year, it grows 1% a year over the 2-year period. And the labor force, instead of going up by 3.5 million, goes up by 5.2 million. Lastly, population. Now, I'm not suggesting that we're going to have a lot of births of 16-year-olds in the immediate future, but the last several years, last 4 years, and we need not get into the whys, but the last 4 years saw an impossibly dramatic collapse in net immigration. Okay, net immigration actually explained half of working age population growth over the previous period. That collapse is embedded in the CBO forecast. It continues, so that working age population grows at 0.6 a year. Okay, it did better than 1% for most of the period before. Simply allow me to take it up to 0.8 a year, so we get a better pop, cyclically driven by both productivity and the end of xenophobia. We get some pop for population, and suddenly, instead of the labor force growing by 3.5%, 3.5 million, it's grown by 5.8 million. You get a cyclical pop for productivity, you get a cyclical pop for participation. Put all that together, and you can grow at 7.2% for 2 years, with the unemployment rate finding its way back to where it was at the end of 2019, roughly 3.5%. Okay, now I'm certainly not suggesting that I know that that's precisely what's going to transpire. What I am suggesting is something between the Summers CBO view and the very optimistic view that I just described. Anywhere along that continuum is reasonable. So I don't know that we'll get all of the improvement I just described, but I also know that Larry Summers doesn't know that we won't. Okay, and even before we think about finance and politics, if we just play in the new Keynesian cartoonish space, and we just say well, should we risk stronger stimulus? What I would say is, instead of conjecturing about what the output gap is, instead of accepting that we're in the slow lane, let's shift into the left lane, pun intended, and let's find out what the output gap is. Find out what the output gap is by, in fact, giving us a really substantial lift. Okay, so Galbraith reminded us that there are only two kinds of economists: those who know they don't know, and those who don't know they don't know. I know I don't know, but I also believe that it would be very important to find out, to get to know where that output gap is, rather than to arbitrarily consign ourselves to the low trajectory that we've been stuck in now for what amounts to over 20 years. Okay. Stimulus to get out of the current malaise would suggest that there's some payoff above and beyond the speed with which we close the output gap. Just a quick comment on that. If you've been in the forecasting business, I was for about 25 years, what you discover very quickly is labor productivity is a critical input, and you have nothing in your tool bag to be able to predict when it's going to shift regimes. Okay, the forecast embedded in the conventional view right now is we're in this slow productivity world of about 1.7%. What powerful econometrics do we bring to bear on that question? The 5-10-year average for labor productivity. The notion that you can build it up from capital deepening, from the ability to get students to learn more, the idea that we can get some sense of the solo residual, none of that works. And so forecasters who are stuck having long run views typically say, well, the next 5 to 10 years is a reasonable bet for the next 20. Okay, now the problem with that, straightforwardly, is we do get regime shifts. I'm not trying to pick on CBO. I worked at CBO, and I think it's an impossible job to make a 25-year forecast, which they have to do to give us long-run budget projections. But think back to 2000, we had a big productivity run, and they extended that productivity run for 25 years. And we're forecasting in 2002 that we would be in big surplus and have paid off all the debt by 2012. Obviously, that didn't turn out to be, but they were betting on 2.7 growth for labor productivity over the period, because that's what the last 5-year average had been. If we take a rolling 25-year average, if we say, let's look from 1975 on at rolling 25-year averages, what we discover is productivity over that whole period ranges between 1.7 and 2.4. And it's above 1.7 93% of the time, and 2/3 of the time it's above 2. So if we ask ourselves the question, does the productivity surge create the boom, or does the boom lift our productivity performance? Can't solve it econometrically, but it's another reason to say, let's go big here and find out whether or not we can elicit some of that gain. So what I would say is, if I was stuck in the cartoon Keynesian space, where I was simply thinking about output gaps, growth rates, and what kind of stimulus we could handle, I would be bigger than the conventional, I would say, small-minded frame that CBO is consigned to and that Larry Summers embraced. But that's not the world we live in. Okay, that's not the world we live in. The cartoon Keynesian space says the economy grows until it bangs up against full employment, and then we have inflation problems, and we need to chart a course that prevents us from having growth that elevates wage and price pressures because they're destabilizing and we get recession. In that frame, where we stand right now is in a situation where we have prospective risks, right? We haven't seen any inflation problem for 20 years. We haven't seen a wage problem for 30 years. It's a prospective risk, okay? If we get no labor productivity pop, no pop for the labor force participation rate, an inflation rate that begins to accelerate, not just transitorily, because right now we've got shortages and we're going to see some of that, but an inflation rate that's persistently higher than we want, and we have a central bank that fails to control it. So if, then we've got a big problem. Okay? That's not the world we're in right now. Let's look back at the last 30 years. Did we have a big wage and price problem in the late 80s and early 90s? No, we had a modest one. The Fed tightened, and then we had the S&L collapse, and we discovered that the junk bond S&L dynamic was the big problem. That's why the recovery in 91, 92, 93 was so paltry. Okay, we had a problem in finance. In the mid-90s, we had the Asian contagion. They didn't have a big inflation problem. They had asset market excesses that collapsed, following on the heels of the spectacular collapse for assets in Japan in 1990. All right, in 2000, wage and prices were very tame. Greenspan dutifully looked at those two variables, said things are fine, there are no excesses, while NASDAQ quadrupled, and we had a big tech bubble that burst. And then, of course, we had the mother and father of all dynamics with the great real estate bubble in the US and elsewhere, and the spectacular 2008-2009 collapse. My point, asset market excesses, not wage and price problems, have been the dynamic that explained every recession until we got the COVID recession from 1985 on. And if you embrace that notion, then what we're thinking about right now, okay, or what we're confronting right now is an extraordinary circumstance. Yes, tech was wildly inflated, okay, in 1999-2000. That, however, was after 10 years of expansion, with the unemployment rate in 2000 at 3.5%. The central bank was in a position based on conventional considerations to begin to lean heavily against that economy, and that bubble burst. Okay. Yes, the housing market was extraordinarily inflated in 2007. It was, however, after 7 years of expansion with the unemployment rate around 4%. Where do we find ourselves today? We find ourselves today with markets that are as extreme. In my really rough approximation to looking at this, we've got an enormous number of signals that suggest we're in bubblicious territory, big time. And at best, we're 8 months into the expansion, where Main Street is still in the early stages of recovery. Okay? So how do we deal with those excesses in finance when we're also very much trying to put the shine back on Main Street? Okay, let's do the Summers CBO counterfactual. It was only 280 billion of stimulus. That allowed us to limp our way out of here. We get some pop as restaurants open. We limp our way back to full employment throughout 2022, 2023. And we wake up in mid-2023 with the funds rate still at 0. Okay, I know the finance quants hate this because it doesn't make any sense, but as long as the funds rate is 0, it looks like the party gets crazier. And so we're in an environment where today's anxiety-producing financial dynamics only worsen over that period. All right. Instead, what we've got is a big fiscal stimulus. a fiscal stimulus that if I get 2/3 of my wish list in terms of productivity, participation rates, and population, which would be spectacularly better than the CBO baseline, it still suggests that doesn't square the circle. And to get to some equilibrium outcome that makes us all more comfortable, it would be appropriate to imagine that dynamic gets us to an equilibrium with a substantially higher interest rate in place. Okay, now in the midst of a boom, a fiscally driven boom, some rise for interest rates that pops asset bubbles, I don't look at that as a bug. I look at that as a feature. I look at that as a better outcome than the one that has us find ourselves limping our way to full employment and aiding and abetting an asset market excess that has some real firepower right now. All right, and now how might that arithmetic work? Okay, if we look at what transpired in 2020, we can come to some rational notions about what the market did, right? Imagine we were in the world where there were only two kinds of companies, FANGs and old uglies, all right? The FANG companies were expected to grow at about 18% a year, and the old uglies were going to grow at 5% a year. And we were in a world where risk-free long rates were 2.5%, sort of 2019. The equity risk premium was 5%, so you had a discount rate of 7.5%. Now, if we applied that discount rate to the two companies, okay, and we, for the moment, I apologize, Hi, but I'm going to embrace Eugene Fama, and we say discounted cash flow rate of return, let's get a value for those two companies, or those two sections. Now we get COVID, we get a spectacular fall for interest rates, and the 10-year no longer yields 2.5, it yields 75 basis points. So with a 5% equity risk premium, we take that discount rate from 7.5 to 5.75. In addition, in a world where we're all hiding under our desks, we decide that the growth rate isn't 18%, it's 20. In that world, all right, the old uglies still think they're going to grow at 5. You got a discount rate of 5.75 instead of 7.5. Turns out that the old uglies go up by 20% because that's a big decline in the discount rate. The FANGs double in value. Okay, now they double in value, and we can say, well, that's rational, as long as that's as far as we go with the analysis. Doubling in value means you think that you're going to grow at 20% a year, or the investors think you'll grow at 20% a year for 25 years in an environment where the top line for the economy is 5%. Okay? If you were 3% of the economy on day one, and you grow at 20 and the economy grows at 5, you are the economy in 25 years. Okay, now why do I say you had to believe that growth rate, that overall growth rate for the economy has to stay moribund, 5% nominal, 4% nominal? Because you're discounting that stream of earnings not by 5.75 for a year or two, but in perpetuity. All right. So what you've got then is a set of stocks that are very, very highly valued based on a view of very strong growth and perpetually no interest rates. Okay, that's a dangerous combination. Imagine some sort of a boom along the lines I described that does require some leaning up against it in terms of interest rates. And what you would discover is The boom will elevate somewhat the old ugly expectations for earnings, a consequence of the rise in interest rates and their change in expectations. It looks like, I don't know if those stocks are up 10% or down 10. FANG stocks, if the interest rate goes from 5.75 to 8, you know, they're going to fall by 50% or some such number. Now, all of these are fanciful numbers, and I don't mean to be giving them any legitimacy. Simply, what I'm saying is, in an environment with a really strong economy that requires some countervailing interest rate increases. In fact, I think I heard a certain Treasury Secretary muse aloud about this before she thought better of it in the short run. In that kind of environment, you get that correction. And if you're saying you're anxious about putting that kind of correction in place, the least worst time to do it, I would submit, it is in an environment where you've got a boom that's being driven by fiscal policy. One last point in that regard. Think about how we got here. How did we find ourselves in an environment where risk assets are on the moon, coming on the heels of a collapse for Main Street so early in the process? The Washington consensus essentially was fiscal policy is not the game we play. All right, we're going to use monetary policy as the stop-go modulator. And if you looked at that process, it was asset bubble excesses, as I described, that explained each of the recessions. And in the aftermath of each recession, it always took more. The low for the Fed funds rate was always lower. Then, of course, we hit the zero bound, and Bernanke gave us QE. And then we had the COVID crisis, and Powell gave us QE squared. Bernanke buying trillions of treasury debt, Powell buying trillions of treasury debt, and lots of corporate debt. Okay, how do we get out from under that dynamic? The only way to get out from under that dynamic, as far as I can see, is to have some other vehicle that's propelling the economy in a strong enough fashion that allows the Fed to back away from both indemnifying corporate debt, buying the lion's share of treasury debt, and implicitly promising that short-term interest rates are zero for the foreseeable future. Okay. Now, lastly, and then I want to open this up for questions. When you listen to many macroeconomists give advice, it's as if they're advising a social planner and an omnipotent individual who can decide precisely what to do. When in fact, you're speaking with people who have a part of the decision-making process. Sometimes they know they can get things through. The reality of the last 12 years is most of the time we've been in stalemate. Okay, so think about the dynamics that Biden faces now. All right, he's got the slimmest definable majority in the Senate. He's got a very slim majority in the House. History suggests that if things were to go along as they normally do, you lose seats in the midterms, which would suggest that he's in perfectly stalemated world as of November of 2022. Okay. This could well then be the only time he has an opportunity to take a big step. Let's also think about what some, and interestingly enough, many of the people who are complaining about the fiscal stimulus, people like Larry Summers, have written extensively on this over the last 4 years. Okay, imagine that you see this world as a world that faces two existential threats. okay? January 6th, the assault on democracy, the willingness to reject the votes of a presidential election, the aggressive attempts at actually trying to suppress votes going forward. COVID denial, climate change denial, in combination, a threat on the globe's ability to support the human species. Right? If you see those two existential threats, well, then probably you see right now this window that Biden has as an opportunity to perhaps change the odds on the 22 November election. Okay, E.J. Dionne, in a piece a few days ago in the Washington Post, put it thusly: in a democracy, any serious governing project is also a political project. Presidents who want their achievements to endure know they must create majorities to sustain their vision over time. Now, if we're facing several existential threats, one approach, of course, would be to assert that we should eschew traditional democratic actions and take arms. Okay, that for those in the arch right who see different existential threats, that's exactly what January 6th was. Quite thankfully, nobody in the Democratic side is suggesting those kinds of actions are appropriate. But perhaps it is appropriate to take a page from the GOP strategy of the last 40 years. What was the GOP strategy of the last 40 years, starting with Ronald Reagan? Okay. Large tax cuts that provided money, put money into constituents and donor hands. And even though you promised they would pay for themselves, the more important point is there were large tax cuts that didn't cause a problem. And the Dems for years screamed and yelled about the fact that, see, the deficit went up. The deficit went up. Yes, the deficit did go up. And nothing happened. Okay, I'm not saying deficits can go to the moon. If we give everybody $1 million check tomorrow, we will have enormous problems in terms of debt levels and inflation and all sorts of things. But for a much larger piece, when you've got excess capacity, you can dole out the goods. In that sense, after Republicans have dined out on that free lunch for 40 years, Biden is saying, I'm going to do something now, and it's big, and it'll make your life somewhat better. And don't forget, in November of 2022. So when I look at the cartoon version, I still see a justification for big fiscal. When I superimpose on it the extraordinary imbalances in finance, it seems to me big fiscal, if it elicits a response in terms of interest rates and some correction in risk assets, that's a feature, not a bug. And if you're among those who think that there are existential threats here in terms of representative democracy and climate change, all policies are risky policies, but going big seems to be the right policy from my perspective. Dimitri, I'll turn it back to you.
Thank you, Bob, very, very much. You know, you are actually in concert with, to some extent, to what we heard in the first speaker, with Charles Evans, the president of the Federal Reserve Bank of Chicago, who, without saying so, I think he meant that the inflation, the concern of the cartoon economists, as you label them, in terms of inflation, is a phantom inflation, more of a fantasy than a reality. But he wasn't so concerned, or he avoided to answer a question regarding the inflated equity markets. So how do we convince the Federal Reserve that, in fact, even with this, as you say, with this output gap, which is different than what's actually been supposed, that they need to act, not because of inflation, but because of the inflated asset prices.
Yeah, Dimitri, I think that's a great question. Let me take a step back first. So, you know, what happened to Minsky's moment? I mean, in my forecasting career, I had some great successes and some disastrous errors. The most shocking development in terms of what I anticipated versus what eventuated. We've been talking about finance as center stage for many decades. And in the aftermath of the Great Recession that took the world apart, I thought we had won. That is to say, I thought that mainstream macro would have to go through a first order change. And Minsky got a lot of play for 2 or 3 years. And what I discovered was people were willing to talk about Minsky retrospectively. Okay? In other words, you respond to financial market problems with the benefit of hindsight, but in the here and now, you can't talk about it and focus on it. Okay? Now, that said, you can make the case that in 2018, something different was going on, right? The mainstream Keynesian analysis was the tightening from the Fed in 2018, early 2019, was completely misguided because despite the fact that the unemployment rate was low, there was nothing going on with wages and prices. Okay, there was with corporate debt, right? Corporate debt had really begun to take off, and you could make the case that without acknowledging it, the central bank was leaning against that because it had some concerns. It had just come through a recession that was brutally 100% finance driven. And we were 8 years into the expansion. But in the current environment, as devoted a Minsky fellow as I am, I couldn't imagine the Fed going after finance right now without some other dynamic that said Main Street will not be one of the sideline victims of a big correction in financial asset prices. So for me right now, what gives the Fed license is a boom, and a finance-driven boom. I think gets us there. When you ask why hasn't the Fed embraced this, how far can the Fed wander explicitly, overtly to everyone from what the conventional mainstream macro says? And so I would throw it back to you and say, how is it that mainstream macro hasn't changed?
Well, I understand what you say, Bob, but there's also the question about the corporate debt, which actually is very high. I mean, the debt levels of corporations are extremely high. A change in monetary policy will have some not only financial repercussions, but also will spill over to the real economy. Even though you say the real economy is more resilient than what we assumed it is.
Okay, but take a step back with me. That's why I'm saying going big on fiscal is so important. Let's say that if you wanted to bank on productivity and participation pops, 75% of my pie in the sky description, all right, and that would allow you to get into a good place for the economy without the Fed having to do anything substantial. Maybe that's 1.3 trillion, some sort of, some number like that. But by going full bore, you're doing something that's going to elicit a big rise for economic activity, robust enough to require an interest rate increase that, yes, will have real economy effects. That's the point. And the real economy effects are such that equilibrium is the funds rate at zero with 500 a billion in stimulus, and equilibrium is the funds rate at 2.5 with 2 trillion. And you've gotten to the same place, but in one case, you got there via big fiscal stimulus and correction in financial asset prices versus modest stimulus and continued angst coming out of the world of finance.
No, Bob, I heard you about the underestimation of the productivity growth, which is very important. I didn't hear you say anything about capacity utilization because we still have a lot of slack there.
Yes, yes, we do. What I was focused on was essentially the growth rate and productivity, and then the only slack that I looked on in my simple model was in the labor markets. And the point about the slack in the labor markets is that's completely captive to what you think happens to participation in population.
Related to this point, though, what is the political stance towards immigration is such that I'm not sure how it would allow us to make this the forecast that
okay. So it was not. It's not as if we instituted a stricture that said we are going to let this many people into the country. We became an enormously inhospitable country, and we saw an extraordinary decline in net immigration. What I'm saying is just the absence of the wolf at the door in an environment where we're booming and jobs are in fact growing at a very rapid rate. Just looking at the data, it suggests one way or another that number is more likely to be higher. And remember, 0.8 is a very low number for working age population growth relative to any period other than the 4 Trump years. Yes, there's a demographic piece to that, but going from 0.6 to 0.8 is not heavy lifting.
I wanted to also ask you, you focused your remarks on the US, and since we live in a globalized world, and this conference also was looking at the other side of the Atlantic, is there anything that you can tell us, this is what you think about the European situation, how that might affect the US?
Yeah, so and the IMF has written extensively on this, and it is another, when you think about the ways in which other things will happen instead of a big inflation problem, certainly the net export line also is an exhaust valve, right? If you go back to 83, 84, and you go back and look at that boom, I quoted you a boom for real GDP growth of 6.7% for 2 years. The fact is, domestic demand grew 8% for 2 years, and we had the big widening of the trade deficit because we both had a boom in the US relative to growth rates abroad, and we had the material rise for the dollar. With really very little chance to have a comparable kind of stimulus coming out of Europe, and China now actually, at least peripatetically, trying to moderate what's going on in that country, I would think that the stimulus estimates that go into GDP should instead go into domestic demand, and then acknowledge that once you adjust for net exports, you're probably going to give 1% away there. But as to the particulars of Europe, I would defer to others.
Are you worried at all about the Chinese resurgence of imports and the current account balance that it's increasing?
For the U.S., you mean?
Yes.
No. How's that for a
You
short
take,
answer?
you take the Eisner position.
The twin deficits, you know, one of the so the MMT crowd, of which you're certainly very familiar, to me, what the MMT crowd understood, a serious traditional Keynesian should have understood, and that is, yes, you can get to a debt level that causes a crisis. But if we look around, look at Italy, look at the UK, look at Japan, look at China, we're a million miles away from those kinds of numbers. And as long as we're not in a situation where we are up against big time capacity, you actually can have stimulus that doesn't elicit these kinds of deficit, either budget deficit or trade deficit anxieties. So when I think about the MMT crowd, they provided the left with the moral equivalent of supply side economics, right? Supply side economics was give a bunch of money to our constituents and nothing bad happens. MMT says give a bunch of money to our constituents and nothing bad happens. I think neither is true as in the extreme, but one of the silver linings of the horrendousness of COVID is it's a lot easier to contemplate MMT kinds of stimulus in the aftermath of this brutal recession.
A question that the audience counts is that can you put your views in context of Charles Goodhart's expectations of higher inflation with regard to the aging demographics?
Yeah, well, I guess, you know, the first country that I focused on for some length of time that suffered from enormous demographic problems for the last 25 years was Japan. And last time I looked, the inflation rate in Japan has been 0. So it just doesn't seem to me that you get from A to B. And my own demographics suggests I won't have to worry about it.
Well, we have no other questions, and I don't have any other questions. So I want to thank you very, very much. As usual, your oratorical skill is unparalleled. So
well, I thank you. Can I add one last thing?
Yes, of course.
Okay. There's a great deal of discussion about the potential for a big bipartisan deal in terms of the ongoing debate about infrastructure. And of course, that would mean a big deal with Mitch McConnell. And I know that I've shared this with some before in this group, but I do think that Mitch McConnell is a strong adherent of the Marxist doctrine. And we've talked about this before. The confusion is it's not Karl Marx, but Groucho Marx. And I would just like to recite for you with a bit of out of tuneness, Groucho Marx's characterization anticipatorily of Mitch McConnell. I don't know what they have to say. It makes no difference anyway. Whatever it is, I'm against it. No matter what it is or who commenced it, I'm against it. Your proposition may be good, but let's have one thing understood. Whatever it is, I'm against it. And even when you've changed it or condensed it, I'm against it. Thank you very much, Dimitri.
Thank you very, very much.